Alright guys, let me ask you something real quick. Does it feel like the economy is weird right now? Not necessarily collapsing or not booming, but just off? Well, you're not crazy for feeling that. A lot of smart people are asking the same exact question: are we quietly heading into a recession in 2026? Well guys, in today's video, I'm breaking it down in plain English so you actually understand what's happening and what to do about it. But first, before I dive into this video, let's define what a recession actually is. A recession isn't just when things feel expensive. Technically, it's a significant slowdown in economic activity that lasts for months. That usually shows up in rising unemployment, declining customer spending, and shrinking business growth. Sometimes you normally hear the 2 consecutive quarters of negative GDP rule, but in reality, guys, it's way more complex than that. Right now, GDP growth has slowed compared to the post-pandemic rebound years. It's not crashing, but it's cooling down. Businesses are hiring more cautiously. Corporate earnings growth has flattened in certain sectors. Consumer spending is still happening, but it's being fueled by more credit than by income growth. That combination makes economists pay a lot of attention to these things. So the first thing I'd like to point out is to talk about jobs, because jobs matter the most. Unemployment is still relatively low historically, but job growth has slowed compared to the hiring boom of 2021 and 2022. Certain industries like tech and media have seen waves of layoffs. When hiring slows before unemployment spikes, that can be an early signal. Employment trends are often a lagging indicator, meaning by the time it looks bad, it's already been slowing for a while. And the next big signal to look at is credit card debt. Credit card balances in the US are near record highs. Delinquency rates are rising, and that's especially amongst younger borrowers. And interest rates on those cards are sitting above 20% for many people. That means that people are borrowing just to maintain their lifestyle. When consumers rely heavily on debt, that's just not sustainable forever. So let's talk about those interest rates. The Federal Reserve raised rates aggressively in 2022 and 2023 to fight inflation. Higher rates slow the economy by making borrowing more expensive. Mortgages, car loans, business loans, all of it more expensive. The goal is to cool inflation without crashing the growth. That balancing act is extremely difficult. Mortgage rates, even till this day, although it has dropped just a little bit, it's still around 6 to 7% if you're living especially in more popular states. And those interest rates are weighing heavy on housing. People who locked in 3% rates during 2020 or 2021 aren't selling. That's created a golden handcuff situation where supply is tight. Fewer home sales means less economic activity tied to housing. Housing is a massive part of the economy. When it slows, everything feels it. And another signal to look out for is when economists are watching the yield curve. When short-term interest rates are higher than long-term interest rates, that's called an inverted yield curve. Historically, that has preceded almost every recession in modern US history. And yes, we've seen periods of inversion recently. That doesn't guarantee a recession tomorrow, but it does mean caution. Now, here's the twist that I'll mention. Corporate profits haven't necessarily collapsed. The stock market hasn't actually shown resilience, especially in large tech companies. A small group of mega cap stocks is carrying a big portion of the market performance. That's not necessarily bad, but it does mean that strength isn't broad-based. When growth is concentrated, it can be fragile. Small businesses are feeling more pressure than large corporations. Higher borrowing costs hit them harder. Labor is more expensive. Insurance costs are rising in many states. If small businesses are slow at hiring, then that trickles into the communities very quickly. That's why local economic data matters too. So, with all of that being said, now let's talk about inflation psychology. Inflation has cooled compared to peak levels, but prices haven't gone back down. Groceries, rent, insurance, they are all still high. So even if inflation is technically lower, people don't feel relief. And when consumers feel squeezed, they pull back their spending. That pullback can slow growth. But here's something important though. Not every slowdown becomes a recession. Sometimes the economy just cools off and stabilizes. That's called a soft landing. The Federal Reserve is trying to engineer exactly that. Slow inflation without mass unemployment. That's what they're looking for. It's possible, but it's rare. So guys, what should you actually do if you're 25 or 35 and you're watching this? First, don't panic. Recessions are normal parts of economic cycles. They've happened many times before and the economy has always recovered. But preparation beats fear every single time. The goal isn't to predict, it's to position. So my advice always is, build your emergency fund if you haven't already. 3 to 6 months of essential expenses is the goal. If your industry feels unstable, lean towards the higher end. Also remember, cash equals flexibility. Flexibility equals power, and power reduces stress. The second thing, protect your income, guys. That might mean upskilling, networking, or diversifying income streams. AI is already here and it's going to change a lot of things. Being adaptable makes you recession resistant. Your earning ability is your biggest asset in your 20s and generally while you're young. So guys, guard it aggressively. The third thing is, be strategic with your debt. High interest credit card debt is dangerous in a slowing economy. Pay it down before aggressively investing. A guaranteed 22% return by eliminating interest beats most market returns. Stability first, growth second. A strong foundation always wins. And if you're investing long term, volatility is not your enemy. In fact, downturns often create opportunity. Historically, markets recover and go on to making new highs. The key is consistency and discipline. Trying to perfectly time recessions usually fails. Time in the market beats timing the market. And finally, guys, understand this. Recessions create opportunity for prepared people. Asset prices drop, competition decreases, skills become more valuable, and if you stay calm while others panic, you're going to be the one that wins long term. Economic seasons change, but discipline compounds. And with that being said, let's quickly zoom out and talk about consumer confidence. When people feel uncertain, they spend less. When they spend less, businesses earn less. When businesses earn less, they hire less. That cycle, guys, that feeds itself quickly. Confidence is what drives momentum more than people realize. Corporate debt is another area to watch. During years of low interest rates, companies borrowed heavily because money was cheap. Now that the rates are higher, refinancing that debt costs more. Some companies can handle it easily, others can't. That's where cracks start to form. And I won't forget to mention the global economy itself. The US doesn't operate in a vacuum, guys. Slower growth in Europe or Asia impacts exports and multinational earnings. Geopolitical tensions can also disrupt supply chains again. Global shocks can speed up domestic slowdowns. Everything now is connected. But here's something empowering though. Our generation is more financially aware than before. You've seen a pandemic crash, you've seen stimulus checks, you've seen inflation spikes, rate hikes, and market volatility, all probably even before turning 30. That experience builds resilience. You are not walking into this blind. You've already adapted once, you can adapt again. The biggest mistake people make during economic uncertainty is freezing. They stop investing, they stop planning, they doom scroll through headlines instead of acting. But wealth isn't built in comfort, it's built in discipline. And disciplined people use uncertainty strategically. So whether 2026 brings a recession, a slowdown, or a soft landing, your strategy should stay the same. Control what you can control. Strengthen your finances. Increase your skills. Keep investing consistently. And remember, economic cycles are temporary, but smart financial habits are permanent. Guys, I want to thank you for watching this video all the way through. If you enjoyed it or you learned anything from it, I'd really appreciate it if you could smash that like button, put a comment down below, and subscribe. I make new videos every single week, so again, I appreciate you watching this all the way through, and I'll see you guys in the next video.